The waste report is bringing lower soybean ending stocks, and yet we are going to speak about a possibility of bullishness on wheat because of some Russia measures. Right here on Connected Farmer, your channel to keep you up to date with the latest trends within agriculture and livestock. Here to comment on that is Mike Zuzolo, President of Global Commodity Analytics. And stay tuned and don't forget to subscribe. So, Mike, what that would mean for the market 15 million bushels less of soybeans in the US as carryovers.
I think first and foremost, Luis, it keeps the weather market in South America very much alive and very much at play as we go through the holidays, as we go into January, especially as that is the major crop making month or sets us up for the major crop making month. In February, obviously, also very important. But I think the other thing that I feel pretty good about right now after the USDA's numbers is we did see the crop size go down in terms of ending stocks. We continue to see demand outpace the supply. And so supply is now still falling faster than demand. And I think what we saw after the report, I had seen some newswire reports that the trade was disappointed that the crop wasn't cut as much as it was. I don't feel that way because we're still looking at the lowest US ending stocks number since the 2013-2014 marketing year. And it still sets up the need for an ample, large amount and size of soybean acres here in the United States in 2021. So I think just the fact that we saw the supplies go down keeps South America very much in play with their production going down. That's the other benefit of the soy crop. We did see USDA move, and I think it was relatively early compared to what they normally do, but they took both the Brazilian soybean, or excuse me, the Argentine soybean crop and the Argentine corn crop down 1 million tons apiece. I think that was a very smart move because it kind of goes along what we've been talking about, how there is probably irreparable damage being done in Argentina at this point. So I think all in all, the soybean number, while the market may have been short-term disappointed and a buy the rumor, sell the fact market, started to be seen after the numbers came out. I think as long as we still see hit and miss rains in South America, the downside in the longer term should be limited.
Yes. Yesterday, we are recording this on Thursday, and yesterday the consultancy Ag Rural from the state of Paraná in Brazil, one of the most affected places by the drought, reduced the Brazilian output to 131.5 million metric tons, which is 600,000 metric tons less than what they projected before. Do you think that could be more realistic than other projections?
Yes, I do, because I'm right now at 130.5. CONAB, I believe, is at 134 plus. That just came out right before the USDA report, and then USDA stayed at 133.0. I believe it is lower than even Agri-Rural's number, especially given some of the weather pros that I buy information from. One in particular that I like gives a predictability or a confidence level on rainfall going all the way out 14 days. And I think it's important that we keep in mind that typically these computer models are very good for 3 to maybe 5 days. But after 5 days, it's hard to get even a 50% confidence level in the rainfall, especially temperatures they can do a little bit better on, but rainfall is very difficult after day 5. And what I'm looking at for the 7-day rainfall in Brazil by this one weather pro, as I call him, he's at 60% to 70% coverage in Brazil of greater than 1 inch. For 10 days out, he goes up to 70 to 80% coverage of 1 inch or more of rainfall. But the confidence factor, the predictability factor in that model after day 5 is 30% at the medium, and he can get up to 50% confidence level, but he can also slide down to 20% confidence level. So I think there's still enough dry areas in Brazil, and the clock is running, that if we only see 60 to 70% coverage of 1 inch or more in the next 7 to 10 days, that's not going to solve the problems of this drought.
And another issue that I mentioned in previous programs was about competitiveness. And there are several factors that are decreasing the Brazilian competitiveness right now. And the newest factor is the Brazilian real is getting stronger in recent days. Is pretty close to the mark of 5 reals for $1. And as this is happening with most emerging markets, do you think that will be a huge factor in the coming months?
I think it will be a big factor. I'm skeptical that it will continue. I think that if the United States doesn't get a fiscal stimulus bill, and we have continued delays in having a president of the United States who can move forward with a new agenda and a new administration, or the old administration, whichever it is, it's gridlock. What we're seeing in the United States is gridlock. And I think that we see major countries like China, and we see major countries like Russia and Brazil and Argentina fighting both the kind of what I would call the twin evils of inflation and government debt. And they go hand in hand. It makes sense because the government debt turns into an inflationary problem because the currency weakens. And what we've seen lately is the currency is strengthening, and it's actually been beneficial in some ways for some of these countries. But I don't see a good pathway forward for the emerging markets to be able to continue to be bought by investors unless the United States and Europe really turn around economically in the early part of 2021. And that is supported by a lot of data from the International Monetary Fund, a lot of research that they've done, and a lot of research that the Bank of International Settlements have done that I've looked at in the past. That when you talk about emerging markets like China and the ASEAN countries, especially, they still rely heavily upon the United States and Europe for a good chunk of their gross domestic product. That gross domestic product then goes into paying down their debt. And I think that's going to be an issue in 2021, in my opinion.
Now I have another question connected to the first question I made you regarding soybeans. What would happen to the soybean market when finally Argentina starts to sell its soybean stocks?
I'm really glad you brought that up, because my biggest concerns, as you know, we've talked about them for several months, is that Argentina is holding on to soybeans and corn, and that China could cancel soybeans because I think they've overbooked their needs. USDA doesn't believe that. USDA kept their Chinese imports at 100 million metric tons. But I think that as you see the weather in Argentina worsen, and as we've gone down this path the last 2 months, it takes pressure off of the idea that China will cancel, because there's going to be less competition in the United States as we get into the first and second quarters of 2021. Similarly, Argentine producers, who are still, from what I can tell, pretty angry at the government still, and not wanting to release their soybeans and their corn, are going to be even less likely to if they see their crops burning up in the fields. So I actually think that if we had to choose a country in South America that would have crop problems in order to keep the soybean prices propped up, it doesn't mean they go shooting sharply higher. I'm saying if they stay above, say, $10 or $10.40 at the futures market at the mercantile exchange, Argentina's drought is serving a better purpose for the global market right now, in my opinion.
As we speak about Argentina, Reuters reported that similar measures of what is known in Argentina as export taxes could be implemented in Russia. I'm not sure if this is very wise, but they want to curb inflation the way Argentina could not curb inflation, and what that would mean for the market if confirmed.
Yeah, this is really an interesting dynamic. You and I have talked about the wheat market, the wheat and how it leads, especially in the grain sector, and also the idea that the government agencies, the IGC, USDA, the government agencies overall are over estimating the supply in wheat for the globe. Well, it was interesting in USDA's report. I, as an analyst that looks at wheat as a leader in the whole market, was very thankful for and happy with the USDA report, along with the idea that Vladimir Putin is not happy about the high domestic food prices, and that's why he wants to put this export tariff potentially in place to bring down the price of bread and some of these key commodities that still mean a lot in countries like Russia. And so when USDA came in and increased world consumption by 7.5 million tons on their report today, and they raised Russian production and raised Australia's production, but still netted out a 4 million ton reduction in world ending stocks, which took us below the lowest trade guess by the Newswire polls. I was very happy with those numbers, because not only do you take pressure off the wheat right now in terms of bigger supplies, which the market continues to think we have, that also, because the USDA raised demand, they're now saying and signaling to the funds, look, your wheat price is low enough, we're attracting more demand. And so the funds are not going to be as eager, I don't think, to sell wheat on rallies because it's found demand. More importantly, I think USDA is going to have to take back eventually this winter the Russian production increase they just gave us today. So not only did we see a demand increase, but I think later down the road we can still see production reductions from the United States, Russia, and Ukraine. And that will even tighten more the ending stocks for wheat, which then I think will lift the corn price especially.
Were you surprised that the USDA had no change for wheat?
No change for wheat in what respect, Luis?
In terms of production?
No, I wasn't surprised by that. And I wasn't surprised by them not changing the corn carryover here in the United States because they made such aggressive moves in the prior reports. But the ending stocks for the United States wheat went down again, and that was due to an increase in exports. And we have to note that USDA added exports of, I think, around 6 million metric tons for corn for China, and they added 500,000 tons for wheat for China. And we see that in the U.S. weekly export sales. We saw it again on Thursday, where China was a buyer of both corn and wheat, and both of those commodities are really starting to move in terms of physical sales that are being made. I looked at the USDA's numbers after the weekly report, and for wheat, we're in week 27 of our marketing year, and we've already hit 73% of the commitments, commitments as a percent of total exports. In corn, we're at week 14, and we've hit 59% of USDA's projection of the commitments already. And in beans, it's absolutely amazing. In week 14 of the marketing year, we're at 88% of what USDA is forecasting. So we've really front end loaded these export numbers and this demand. So I think that really should underpin this market from a standpoint of the funds not wanting to take a net short position anytime soon.
And as we have a strong second wave of coronavirus in the United States, how do you see the global GDP in the US evolving in the coming weeks and months as we have more new lockdowns, but easing lockdowns and a lot of people not being able to comply with those new regulations?
Yeah, this is part of the earlier question you asked about uh, what I see in the US. And this is part of the issue with the gridlock. The longer we have gridlock, the more difficult it will be for our people to accept what the government says because they don't know if those government agencies are in charge or their leaders are going to remain in charge the next 4 years. Boiling it down more to commodities, I think it's still all about the dollar or most about the dollar and the crude oil market because the data, since we've been talking about this, as these hospitalizations in the United States are hitting 107,000 people right now, and deaths have hit a new high of over 3,000 as of the 9th of December. As we see these numbers increase, we are also seeing the energy demand reduced. And so we are seeing a net negative effect on energy consumption, whether it's driving or whether it's travel in general. It's an issue where the energy markets are the best canary in the coal mine for how much it's going to hurt the other commodities. And so as long as I see energy markets going higher for a variety of reasons and the dollar going lower, I don't have to be as nervous about getting hedges in place for my agriculture producers. But once I see that turn and the dollar strengthens and the energies weaken, I have to really move quickly for livestock people first and then the grain people after that.
Yeah, we had an increase in livestock production in about 15 million metric tons from the USDA waste. And do you think that was what the market was expecting?
Yeah, I do. And I think that can be partially offset by the fact that we do have a very current cattle cycle right now. And one of the things that came out this week, I think is important for the meat producers out there, is that ABARIS, the official Australian agency for essentially the Australian USDA or the Australian CONAB, they came out and talked about their meat expectations this past week. And they are in Australia not even close to building their herd back. They are not retaining females to build their cattle herd back, their beef cattle herd especially. And so it seems to me that there's going to continue to be less and less competition from Australia between the Chinese-Australian trade disagreement and then also just the natural production cycle right now. They're going to have to at some point retain females and take potential marketings off the supply side. So, and I think that'll happen in 2021, but so far they haven't done it. So I think that just adds to the prospects if the dollar stays weak, that our pork and beef demand overseas will remain strong.
What about beef?
Yeah, this is where I still am a hedger at the right price. USDA came out with updated expectations. They raised their second quarter cattle price for steers here in the United States. They went from 110 to 113 per hundredweight. I'm still targeting that 119 to 120 level in April CME cattle futures as places to get hedges in place, mainly because I'm nervous about what this COVID spike is going to do to us in first quarter demand.
Now, what's your summarized marketing strategy?
I think we're still in the middle of a weather market in South America. And I think the charts and the technicals, even though they're overbought and the momentum indicators are starting to suggest that we could sell off, I don't foresee that as being a big, harsh sell-off in the big picture or the medium term. And I'm still probably looking at buying back some of my soybean sales from 2020 and not really wanting to sell any more 2021 crop at this stage until we go back up and test the old highs. So that's how I see it heading into the holidays and heading into that January report, Luis.
Michael Zuzolo, always bright. Thank you.
Thanks, Luis. Have a nice week.